Welcome back to Starting Up and Right, Conversations with a Startup CFO. I am your co-host, Trey Nicholson. Joining me on screen is your other co-host, Ryan Keating, and the Startup CFO. Hey, Ryan.
Trey, how are you?
Good. Doing good here. Today, we've got a friend of ours. We've got a longtime friend of yours, Mr. Greg Ennis of Peninsula Ventures. Greg is a venture capitalist. And rather than me trying to describe Greg, you've known him for a long time. You guys were, office mates for a long time, way back in the day. Just give Greg a little intro, kind of from your perspective, if you will.
Yeah, my pleasure. Greg and I first met probably 15 years ago, where I was the CFO for one of Peninsula Ventures' portfolio companies, and really enjoyed my interactions with all of Peninsula Ventures, and we stayed pretty close. We actually ended up sharing an office space together at one point. And during that time, I think my interest in what the venture side of the table looked like really expanded. I really started to pester Greg quite a bit. He won't probably admit this, or he'll use more colorful words, but I would come to him and ask him a lot about how it worked and how fund economics worked. And really with the idea of, I was really excited about a lot of the companies we were working with on the CFO side, and I was interested in how do we also invest in those companies. So I kind of wore Greg down enough where he said, look, why don't we look at maybe raising a fund, and with the thesis of, finding companies that you're working with matched with some other investment strategies, and use this as a way to go out and let's see if we have, access to some interesting startups. So now, not only do Greg and I work together as, I'm a CFO on startups and he's an investor and board member in several startups, but we're also co-GPs on a couple of the Peninsula Venture funds. So I got to get to wear both hats, and it's very valuable to me where I get to reach out to him and get his advice, where, as you introduced him, he is truly a card-carrying venture capitalist. He's been one for probably going 25, 30 years, and really knows the ins and outs of this industry. So I'm really happy to have him on today, and get some good tips and insights into how this works.
Cool. Well, Greg, you're on screen now, so welcome. Thanks for joining.
Yeah, thanks for having me.
Well, Greg, a little bit about your background. Ryan got to tell his side of the story. How'd you get into venture capital? Start way back in your Stanford days, if you don't mind, because you were a quarterback.
My former life,
heard legend.
Yeah. In fact, I like to tell everyone that I won the Heisman in '87 because no one remembers who actually won it. So it always helps. No, ironically, that's how I got somewhat introduced to venture. So I was going to school playing ball and looking for summer jobs, and met a guy who basically allowed me to tail around with him one summer by the name of Bob Patterson, and half of his time was in a law firm, half of his time was in a venture fund. So that's how I got exposed to venture. Fast forward 4 years later, I was coming out of business school, and Bob and I had stayed in contact. And I'm looking for a job coming out of business school in '92. And he said, get up here, we're interviewing at Thompson Clive, which was the firm that he was with. And so I flew up, and I met Richard Thompson, the founder. And I like to joke that, they made the mistake of hiring me. So that was back in '92. So I spent about 8 years with Thompson Clive. By the end of that period, running their US office. They were a London-based firm. And then in 2000, Bob and I spun out and created Peninsula. And we are now on Fund 4 of Peninsula. We've been doing early stage tech investing, or I've been doing it for 29 years now.
So Greg, to kick off, if you don't mind, just starting at a higher level. I mean, we're all coming out of COVID. There certainly seems to be a lot of activity, especially in the startup markets, a lot of hiring, a lot of fundraising, a lot of momentum. What are you seeing right now, just at a macro view, in early stage investing and where the markets are?
Yeah, I think the markets are probably as hot as they've been in 20 plus years. I don't think they're quite at the .com craziness, But they're not too far off from that. People aren't running around getting term sheets in hours by any means, but it's a healthy frothy market, a lot of capital, but there's also a lot of good deals. So, we're looking at stuff, and yeah, there's things that come across our desk that are just way overpriced and crazy. But there are also some real deals. We've got a couple right now that I'm feeling pretty optimistic about, where the valuations are reasonable, where we can still generate a venture return on them without having to, generate the $1 billion exit. So, I think the venture market's healthy right now. I think the pace of venture investing has increased during COVID. So, I think everyone, when we came into this pandemic, everyone thought, oh, we're going to hunker down. And, as we come out of it, that's when the real flow of capital will happen. I think it's just the opposite. I think the flow kept flowing through the pandemic. Now, the question is, as we're coming out, will it accelerate, stay the same, or go down? I don't know. Have no clue. I think that the quality of deals that we're seeing is good enough. I think the amount of investing will probably stay the same. I don't think it'll go up much more than this for the next year or two. But yeah, there's some really good stuff out there.
So the volume of deals COVID didn't maybe even accelerated that. As you mentioned, I think previously we were talking before the show that a Zoom allows you to see many more pitches and speak to many more founders. Yeah,
it was kind of maybe it's predictable if we all sat back and thought about it, right? But the pace of the deals has increased because, quite frankly, you can do Zoom calls one right after the other. Whereas before, I'm going to meet an entrepreneur, it takes me an hour to get there. Or if I'm flying somewhere, it takes me a day. Yeah. So the pace in which we're seeing deals is a lot faster.
So most of our portfolio companies, as you know, are very early stage. A lot of them are looking to raise their first priced round, maybe their second priced round. What kind of advice, if you can, would you share with them as they go about, most of it is like the pitch deck or presenting. And you did mention a comment that you share that you use a lot, and I'll quote you quite often. I won't often give you credit, but I'll quote you quite often. And one of the things that I like to say that you think of is, whenever you're trying to get an investor on board, one of the goals is we're basically asking them to take a leap of faith. And one of our goals is to make that leap as small as possible, as short as possible. So what have we shown them? What can you do? And this translates into what we talked about a little bit, maybe traction. But what are some kind of pieces of advice, if you don't mind, for people that are getting ready to go out and raise a round?
I would say practice the pitch deck 1,000,000 times, iterate it, get as much advice as possible. If the investor doesn't know exactly what the problem is and how you solve it within 3 slides, you're not doing it right. Their attention span isn't going to last past that. So if you haven't got that, get it, fix it. If you do have a real problem out there in the market and you have a solution for it, and you've got customers who, swear by it, then quite frankly, you should be able to raise money. Yeah. Plain and simple. You should be able to raise money. And if you're not, there's something wrong with the pitch, how you're approaching it, the business model, whatever. But if you have a product, software, whatever, that solves a real problem for a customer and a customer is willing to pay for it, that's what it boils down to, right? Something that simple. And then the question is, okay, well, how many of those customers out there? How big is the market? How much can we charge? Where, can we do it in a profitable way? All of that stuff. But fundamentally, if you have a product and a problem and you're solving something for a customer who's willing to pay for it, you should be able to get funded in that stage, Ryan, right? Because those are the early stages. As once you kind of have that, then it's either, okay, I need money to turn the flywheel faster or expand and do X, Y, and Z. But it's that first money in where you got to prove to an investor that There's a real problem. Your product solves it, and the customers are willing to pay for it.
Nice.
It's really pretty that simple, right? And if you can't, you have to convince an investor of that quickly, and then also that there's enough of those customers out there such that there's a big enough market, and we can put money in and we can invest it, 2 million, 5 million, 10 million, whatever, but we can get out at 50, 100, 500, a billion, whatever that number is, right? But you see the order of magnitude. We have to see the way of putting money in at whatever value, but then driving a value on an exit such that we can generate a venture return.
Sure.
But those early stages, it should be pretty straightforward and simple. If it isn't, figure out why it isn't, because that's going to be the challenge.
That's good. That's good. And you're right. It's very different at this early stage than, say, what we would consider a growth round.
Yeah, or even an A round.
Yeah,
right?
which
like
I say
talking earlier,
yeah.
the A used to be the early round. The A is really now my product's done, product market fit exists. I've got customers. I've got quite a few customers, and I figure out the flywheel on how to drive it. So now I need money to invest in that flywheel.
Yeah.
And then the B is you hit 10 million in ARR. Now we're really going to step on the gas and we're going to go international or expand our product line or whatever it is, right?
Yeah.
But that's the B now.
Yeah, it's really shifted since even I've been in this, just because I'm younger, but not by much.
Thanks a lot.
And no, it's funny. You're right. It used to be that, and we'll talk to clients about this as well, that we used to call it a Series A because that was generally the first. A as in the first letter. And nowadays we'll see it as the fourth round of funding. Yeah. You'll see a SAFE or convertible note, and then oftentimes a pre-seed followed by a seed and then a Series A. It's really amazing how the funding has shifted. And, I see a lot of that, and I'd be interested in your comments on this, but, you had made a comment earlier about so much money coming in. And I think a lot of this is over the last 15 years, there has been so much money come into venture that for these smaller funds that don't have the deal flow, don't have the reputation, they have to keep getting in earlier and earlier to get in front of the larger, more established funds. So.
Yeah. We actually experienced that quite significantly in our second fund. Back in the day, when I first started in venture, we were located at 3000 Sand Hill, which was Mecca in venture capital. And we would share deals with and look at deals with the Kleiners and Sequoias and USVPs and, all of the big names. Because quite frankly, back then they were big names, but on a much smaller scale. Whereas when we raised our second Peninsula fund, we were doing Series A lead investing. And what we found was that we were no longer sharing deals with those firms, but competing with them and competing with them in Silicon Valley, hence the name Peninsula. What was interesting was that we experienced exactly that, which was the deals that we would go head to head with them, we weren't winning. We weren't a brand name. So we had to go earlier and assume more risk. We also, I think serendipitously, went outside the Bay Area and found I want to say much better. We found better deals for our firm and for our type of investing than what we were finding in Silicon Valley. Sure. So it became interesting in that how these funds have grown. I remember back when I think it was Kleiner that raised the first $100 million fund. And there was talk around, Sand Hill Road. Jesus Christ, how are they going to invest that? That's crazy.
100 million.
100 million, Now 100 million is a seed fund. Exaggerating a bit, but not by much. So what's happened is that the asset class went from a cottage industry to a valid asset class for institutions. So now if you go to any large institution, when you say, what's your asset class allocation model, they'll have venture slated in there. Whereas 30 years ago, very few of them ever included any private equity or venture. So it's an accepted asset class now. So which means more money's come in. There are times when I'd say it's a bad thing, but overall, I think it's a good thing. I think there's created an engine for innovation and job creation in America because of this. I think Silicon Valley is Silicon Valley partly because of this. It was Silicon Valley prior to this, but my point is that it accelerated it. Every other part of the country wants to replicate what Silicon Valley has done. Some have done it very well in their own flavor. Some are still trying and so forth. So, I think the amount of capital that's come in has been good. I think what's interesting is that with COVID and with now remote working, there's a lot of companies, I'll pick on Silicon Valley, a lot of companies in the Bay Area, it's like, well, yeah, sure, we're still going to be, headquartered here, but we got people working in Utah and in Arizona and in Nevada, because quite frankly, we're all remote anyway. We don't need the office space or as much office space. We don't need everybody to live here.
Right.
And so I'm hoping that a byproduct of that is the cost for building companies, particularly in Silicon Valley, comes down a bit. Because that seemed to be one of the challenges that investing in Silicon Valley had.
I want to talk about board meetings because that's one of the central theses for our show here, Greg, is to help our founders anticipate, prepare for board meetings. You sit on several boards from a very top level. How can a CEO best prepare and use a board effectively? Just give us a little, what are your thoughts on board meetings?
I have a lot of thoughts on board meetings. First off, nothing new should ever be reported in a board meeting. If you're talking to your directors only at board meetings, you're doing something wrong. You should be on the phone with them constantly. If you ever come to a board meeting and say, there was a problem, but we fixed it, and that's the first time the board's hearing about it, you're doing something wrong. Be open, be transparent. I'll tell you, the best CEOs I've worked with are those that say, I don't know how to fix this. The worst ones are the ones that say, I know how to fix everything. So, it's one of those things where constantly be talking with your directors. Nothing should be a surprise. Understand the directors are there to help solve problems. If you have a director, and most directors are not this way, but if you have a director that is ready, fire, aim, you have the wrong director. Most of the directors are, okay, what's the problem? All right, I've seen this. We've had this happen in 3 other companies. Here's what we've done. What are you thinking? We'll work through it to figure out the right solution. But if you're so afraid of showing any weakness or vulnerability to your directors, you got to change that attitude. It's got to be completely flipped.
That is a weakness, right?
It's absolutely a weakness. If you have an inability to show vulnerability or lack of knowledge, or, hey, I don't know how to fix this, or quite frankly, I think I know how to fix this, but I want to talk to you about it.
Yeah.
All that is great, because what you do by doing that is you bring that venture guy in, realizing that, okay, I can trust him. If he's got a problem, he's going to call me. We're going to figure it out together. When you're not sharing anything, any problems, or if you do share a problem, but it's been fixed, what you're instilling in a venture guy is, what else have you not told me? So be open, be transparent. The venture guy, understand, he wants you to succeed. He put money in you for a reason. So therefore, open up and share your problems with them. We also understand being a CEO, that's a lonely freaking position. Who do you talk to? Who in the company can you really go talk to about shit? Right? Maybe a CFO if you got it. But usually at the early stages, and you're worried about making payroll, you go talk to the employees about that?
Bad idea.
Bad idea, right? I mean, we get it. We understand that it's a lonely position. And quite frankly, if you don't avail yourself to the board and to your venture guys, you're making a huge mistake. With regards to board meetings, like I said, nothing should ever be new. The other thing that I find interesting is that a lot of board meetings are, well, we got to update the board on what's going on. Well, do those in pre-reads. Get those things out beforehand. Let people do the reading so that they can come to the meeting prepared, such that you don't have to waste people's time talking at them, updating them. As a CEO, what you should be doing is, what are the 1, 2, 3 questions that I need answered that my board can help me answer? And if you can't come up with those questions, think harder, because they're there. No business is perfect to the point where you don't have problems to solve. So what I tell our CEOs is, cater your board meeting around a question or two. What are the questions that I'm trying to get answered, right? And obviously there might be people on the board that may have more experience in some areas and you want to tap that. That's great. But come to the board meeting with questions, right? Here's what I need from you guys, right? Provide the information up front so that you don't have to waste their time updating them, and then get into the meat and have the dialogue, have the debates. Because in the end, when you do that, the better or best answers always come out.
Yeah.
And that's how you use your board. And ironically, that's when the board starts to believe and trust in you more. I think the good board meetings are the ones where you have really meaty subjects and good debate. Healthy, respectful, civil, but good debate. And
the heart rate gets pumping a little bit in some of those,
to some degree, but it's more intellectually, it's more intellectual, and it's like, we got to figure this out and make sure we're doing the right thing. And it's not so much it's my way or the highway. It's more of a dialogue that everybody kind of coalesces. And what's interesting is that when you have a group of people who are trying to get to the right solution, when the right solution presents itself, everyone kind of gets on board. And that's why, I joke when people say, oh, we need to have an odd number, of board members so that when we take a vote, if you're taking a vote at a board meeting, something's wrong. Seriously. I mean, it should be, unanimous or a consensus of, yeah, that's the right thing to do. If it isn't, and if it's a 3-2 vote, I'd suggest go back and figure out, how do you get to a 5-0 vote?
Interesting. One of the things we sit in a lot of board meetings and help and present with our clients. And we always speak to the financial update. The financial update's always at the end. And we always share the slide 2-3 days early. And I'll tell them, a good board meeting, we don't even get to my stuff because it's not a topic. The topic is the meat of what are we doing with the product? What are we doing with sales? What are we doing with features? If we spend our time talking about my slides, there's a problem. And so I always like to say, like you're saying, share this stuff early, make sure everything's accurate, give them the KPIs, give them the runway and all the metrics, but communicate so frequently that shouldn't be taking up discussion time. Discussion time should be on, where are we at on our go-to-market? Where are we at on our key hires? Where are we at on our beta versus our MVP versus our pilot? So I love it when we prepare for a board meeting. And I'm like, I hope we don't get to finance, because that means that we don't have anything else to talk about if we're worried about the overspend on travel last month.
Yeah.
So.
Couldn't agree more.
So Greg, you're in Portland now. You make it down to the Bay Area, and you mentioned the geography's kind of melting away in what you do anyway, but how are you enjoying Portland? What do you do up there for fun?
Oh, we've been loving Portland. We've been up here now for about 5.5 years. After a week of getting up here, my wife and I looked at each other and said, why did we wait so long? Life is easier here. I was telling you guys earlier, I have a meeting downtown. It'll take me 10 minutes to get there and park. So, there's just a level of easiness here. We love to ski. We love to fish. We love the outdoors. The Pacific Northwest is just incredible. We actually like seasons too. So the rain and the snow don't bother us. So in the wintertime, you hunker down a little bit more. Your house projects that you work on are inside. I think we bought this old house. It's a 110-year-old house.
Oh, wow.
So the house projects never end. But just finished a guest bathroom about 3 weeks ago. And now I'm looking, since the weather's changed, I'm looking for my outdoor project, which is replacing a new deck.
Oh, fun.
And when football season starts up, will you visit? You come down here for the games?
We do. We still come
Yeah.
down for the games. Obviously missed them all last year because he couldn't go to them anyway.
Yeah.
But yeah, we still get down, still have family in the Bay Area. And so, yeah, we'll make it down, and it'll be nice to get back into a regular schedule for that as well.
No doubt. Good.
Well, thanks for joining. It's always fun for me to hear a CFO and a VC/board member talk about how to interface. But
Good. Yeah. Thanks, Greg. That was a lot of fun. I appreciate you joining us.
No, happy to do it. It's always fun to talk with you guys, and appreciate everything you do for your portfolio companies and our portfolio companies, right?
Enjoy it. Thank you. And thanks, Trey.
thanks, guys.
Yeah. Thanks, Trey.